Good morning, and thanks for your interest. For those of you whom I haven't met, my name is Alex Abel, and I'm the Fund Manager for APN Industrial REIT. I'm out at Derrimut this morning, which is an industrial and logistics hub in the western suburbs of Melbourne, where we own 3 properties valued at over $60 million. I thought I would take a few moments whilst I'm out here to find a quiet space and run you through our results to 31 December 2018. I'm pleased to report it was another period of growth, with statutory net profit up 5.8% to $14.6 million and funds from operations up 3.3% to 9.4 cents per security. The earnings growth has largely been delivered by contracted rent reviews across the portfolio, where more than 80% of leases have fixed uplifts of 3% or more, leasing activities and new acquisitions. Leasing has been the major highlight of this period, with 6,600 square metres of leasing completed. Of that number, 2,900 square metres was vacancy at BTP, where we refined our focus on small to medium-sized businesses that required less than 500 square metres and represented 90% of our deal flow. This segment of the market are often underserviced, yet they've got high demand for quality buildings combined with a flexible and proactive management approach. This plays to our competitive advantages, which is having an on-the-ground management presence to deliver simple solutions and constant improvement to our tenants, and leveraging the variety of product offerings we have with 12 buildings under ownership. The success we had at BTP, combined with further lease up at Adelaide Airport, resulted in occupancy increasing to 96%. Income visibility has also improved further, with less than 10% of leases expiring over the next 18 months. We also settled the acquisition of 2 assets for $26.3 million. We've considered over $1 billion of potential acquisitions over the past couple of years, and what stood out for the properties that we bought were their locations, which are in close proximity to arterial roads, minimising the impact of traffic constraints. The flexibility of those warehouses to cater for a variety of tenants that reduces downtime risk, and most importantly, that we could acquire at a price that provides the ability to generate sustainable income returns over the long term. The acquisition yields averaged 7.1%, and the weighted average lease expiry was 5.7 years. We consider those metrics to be very attractive and will continue to remain patient and selective when pursuing further growth opportunities. We externally revalued 2 roads properties during the period, which resulted in $3.1 million of valuation uplifts. The increases were largely as a result of our leasing activities last period and contributed to a 1 cent uplift in net tangible assets to $2.71 per security. Gearing also increased slightly to 33%, which is towards the bottom of our target 30 to 40% range. Refinancing risks remain relatively low as we have debt maturities staggered over 4 financial years, and the weighted average cost of debt was 3.6%. For the full year, we've reaffirmed our guidance at 3 to 4% FFO growth and 3% distribution growth to 17 cents per security. In terms of operation and strategy, they will remain consistent. We will continue to refine and adapt our approach to working with businesses to allow them to focus on their core business, whilst also continuing to seek out investments that provide well-located and affordable workspaces for the business that provide sustainable, long-term income returns. Thanks again for your interest, and I look forward to the opportunity to meet with you shortly.